You're entering your fifth year as CEO. You're in such a different place than you were even 6 months ago. Your stock is actually holding up better than every single one of your rivals. But the reality, too, is here that everyone is preparing for what could be a mild or even deeper recession. As the CEO of Goldman Sachs, how do you prepare your bank for that?
Well, first of all, thank you for having me, and I'm delighted to be here with you, and I appreciate your being at our financial services conference. This is the 33rd year. We've got a terrific group of clients here, and it's a great time to kind of reflect on our industry and really look at our industry going forward. I think you framed it just correctly. We're at a very uncertain time, an uncertain time given we're changing monetary and economic conditions very, very quickly, and that's certainly having an impact to slowing down economic activity. And so if you're running a big financial services firm, I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization. I think you have to expect that activity levels are going to be more constrained in a tougher economic environment. So we have businesses that are very, very correlated to economic growth in the world, and we're predicting economic growth will slow. Our economists predict 1.9% economic growth around the world in 2023, which is obviously slowing growth. And the big question is, as central banks tighten monetary conditions and try to control inflation, can they do that and orchestrate some sort of a soft landing? And I think that's still uncertain. I think there's a possibility of that, but I certainly think we could see a recession in 2023 also. And so I think you've got to be cautious and prepare.
How then do you prepare your staff around all of this? It's December, it's the end of the year. People are worried about jobs. People are thinking about jobs. They're thinking about pay as well. It's bonus season coming up. We've reported that you are even thinking about having lower bonuses at businesses that will have rising revenue this year. How are you thinking about this? Bring us inside your decision-making process and what you're telling your staff right now.
Well, we operate a business where every single year we have to pay our most important asset, which is our people. It shouldn't be surprising to people watching the performance of the business this year that 2021 was an exceptional year. It was a record year for the firm. It was the highest net revenue year ever for the firm. 2022 is a different year, and so naturally, compensation will be lower. We're still early in the process of making those decisions, but just like every year, we pay for performance, and we will pay people based on the overall performance of the firm, and especially for our senior people, we consider the overall performance of the firm as we go through our compensation process.
How do you balance also, this year you had been reintroduced the natural culling of headcount. The bonus discussion is not just here, it's obviously everywhere on Wall Street. How do you balance that with kind of the story that we saw just a year ago, this talent war that we saw, this booming market for people, and what's happening this year going into next year into tougher times? How do you balance retention as well as those more difficult conversations?
Well, we take a very long-term view with everything we do, and you have to adjust to the environment, and so you make changes around the margin, but at the same point, you take a long-term view and you try to think about your business over time. We're extremely focused on serving our clients and our core businesses. Our clients have been active, and so it's important for us to strike the right balance in protecting our franchise and making sure that our people are paid for performance. On the other hand, we're in an environment that's a tougher environment broadly. Performance is not as strong, and so we balance that. But we take a long-term view. Our people take a long-term view. But I just made some comments in the Financial Services Forum where I said that I'm surprised by how resilient the competition for talent is. And by the way, this is just not in our industry. You're seeing across the United States and around the world that labor is still relatively tight.
Talent war is not over.
The talent war is I think there's some headwinds given we're changing economic conditions, but the competition for talent is still very, very strong. Now, how that evolves in 2023 is unknown. Certainly, if we have a slower economic environment, it will have an effect. You can see across all industries, not just tech, that people are thinking about their headcount size and they're making, let's say, pruning cuts or adjustments just because they feel more margin pressure coming. So financial services is not immune to that, and I think we all have to watch the environment and make the right long-term decisions for our organizations and for our shareholders.
Whether it's headcount or otherwise, as you think about this kind of tougher economic environment, the uncertainty, do you think Goldman is going to have to pursue another round of cost cuts in any fashion? And if that were to be the case, where could you see them?
Well, we always look at the environment and we always size the firm to the environment. If the environment gets tougher, we will obviously honestly make decisions to size the footprint of the firm appropriately. That can come from slowing down hiring, which we've already done considerably in the second half of the year, and that might also come from pruning in certain areas.
So switching gears a little bit here, kind of broader financial services picture and talent war and whatnot. Last year, fintech, crypto firms booming. I'm curious whether the collapse of FTX is making you think in any fashion differently about crypto as an industry and the ability to potentially invest in some firms, maybe buy some assets here.
Well, I've been very clear on my view around this space. I think the underlying technology of blockchain is extremely interesting. I think there are enormous opportunities for blockchain to play a role in evolving the infrastructure of our financial system. I think there's an enormous amount of friction in the way money moves. I think there are a variety of ways that this technology can be used to allow more participation and inclusive participation in financial activities. I think it can break down barriers. That has nothing to do with Bitcoin or a cryptocurrency. I don't really, offer a view on cryptocurrencies. I think they're highly speculative. They may hold value, they may not. But I'm interested in the underlying technology and how the underlying technology can help serve our clients, our customers, and really take friction out of the financial system and also help make it more accessible.
But the reality, too, is kind of Goldman was pretty early in the market here when it came to futures trading, when it came to the industry at large. Do you think that there's a chance to lean in, or is there still too many regulatory risks?
Well, when you say we're early, we've done a very narrow selection of things around this broad area because from a regulatory perspective, we're extremely limited in terms of our participation. And I don't see that changing in the immediate future. And so we want to be available to give our clients advice and insight into how we think about some of these things. But our activities are extremely limited in the space.
I want to take a moment to realize it's about to be a big moment, year 5, that you're becoming CEO here, that you've been running this firm for. Is there anything you didn't do in the first 5 years that will kind of be at the top of your list here to execute as you enter this kind of new phase?
Well, we laid out, and I know you were there because you covered it as a reporter in our first Investor Day 3 years ago, a desire to grow the firm, to diversify its revenue base and make it more durable, to operate the firm more efficiently. And in particular, we focused on the opportunities for us in asset management, wealth management. And on our recent reorganization, we've now got those businesses together. We run the 5th largest active asset manager in the world. We have a jewel of a wealth management business, and we see real opportunity in the coming years to continue to grow that. And so we're on a journey to diversify the firm. I think the thing that we're most proud of over the course of the first few years, and I think our team's done an extraordinary job, is at the time of that Investor Day, there was a lot of skepticism about our markets franchise, particularly our FICC franchise, the returns we could generate, our client position in that business, and we've really strengthened that business. That is a leading franchise that's performing very well. We've taken over 300 basis points of market share in that franchise, and that's really made the firm, it's our biggest business, it's made the firm much stronger. We've really focused, I'm sorry to interrupt you for a second, Sonali, we've really focused on the client experience and making sure that the way we serve our clients is really, really differentiated. And we're getting great feedback from clients on that, and that's strengthening our business. So we're on this journey to diversify the business, to strengthen the business. I think we've made a lot of progress, but we have a lot of work to do. And we continue to focus on growing and strengthening the firm.
So you're leaning into so much of the core of Goldman Sachs. A couple of months ago, you announced this general realignment, let's say, of Marcus and the consumer strategy. Do you expect more big changes to be announced ahead as you have your next big Investor Day coming up? Do you think that you'll have a target here? Do you have any sense of when it can become profitable?
Well, we made a very purposeful decision in this reorganization, which was a significant decision, to organize the business into 3 units. Our asset and wealth management business, which we were just discussing, our banking and markets business, which I was highlighting the strength of the markets franchise, and obviously our investment banking franchise is a leading franchise. And we took our platform businesses, transaction banking and our consumer platforms, and we put them together. We narrowed our focus purposefully on our consumer business and tried to align it with things that we think really play to our strength, whether it's the technology development of platforms, our relationship to enterprise businesses, and also in alignment with our wealth business. With that narrowed focus, we're going to be very, very attentive to making sure we scale those platforms and they're profitable as quickly as possible.
David, year 5, you look around all of corporate America, not just Wall Street, really, and you see so many companies, as they think about succession planning, the CEOs have had to come back on multiple occasions. You see it at Disney, you've seen it at Carlyle. When it comes to Goldman Sachs, how are you thinking about succession planning now as you kind of move into this next part of your career?
I am in year 5. I've got a great team. We're working on all the things we were just talking about, and that's what I'm focused on. And there'll be a time when it will be someone else's turn to steward this great institution that's been around for 153, 154 years. And at that time, we'll make the appropriate decisions. But for right now, this leadership team is really focused on continuing to grow and strengthen Goldman Sachs. And we feel like we've made a lot of progress, but we also feel like there's a lot that we can do. And we're excited to talk about some more of that in February.